Welcome, FBS 705 class, to this next online lecture series that we have together, Valuations. Importantly, before we go down into detail as to how the module is structured, what we need to do, how we need to go about it, we need to establish a couple of key principles up front and a couple of things relating to the module that we need to take into account. Firstly, and I cannot stress this enough, we need to emphasize the importance of valuations, not only in the context of FBS and your CTA lecture, but also in the context of your overall CA journey, both for ITC and APC. The reason for this is valuations is not only built on the principles of technical competence, being able to do something, it also requires critical thinking, because you need to apply the various methods that we're going to unpack to a broad range of scenarios. And unfortunately, where most often students struggle, is the realization that one solution does not fit all. And we need to be able to apply the techniques and the skills that we unpack to various complex scenarios. The second aspect that we need to bear in mind, building on this, is the fact that it requires our undivided attention. We need to make sure that we work through all the videos, you listen to my voice over and over and over again until the point sinks in and until you're able to grasp the concept that we are trying to explain from the various videos. And I say we because this module is not only going to be done by myself, but it's also going to be taken in part by Mr. Plant. He's going to take you through some of the critical aspects towards the latter part of this particular module. So what we require from you up front to put all cards on the table is we require you to work through the videos systematically, critically think about what we're saying, work through those lecture examples, work through the tutorial question base, come prepared to our online Collaborate sessions, ready to ask those pressing questions. So by the time that this module ends, by the time 22 May comes around, you're in a situation and you're in an environment where you are best prepared to tackle anything we can throw at you relating to valuations. Importantly, we're going to be working out of our Sky textbook. It's going to be chapters 10 and chapters 11, but as it says in our online study program, we will provide you with all the information that you need in the lecture slides and in our explanations of the various concepts. We're doing this, and we're going to probably put a little bit of extra detail into this because we know that not everyone has access to the various textbooks at this stage. However, in order to aid those people that do, we will make reference to chapter references where applicable. Looking straight into detail and going out into the module outcomes, where do we want to be and what do we want to have unpacked by the time 22 May comes around? Importantly, we want to be able to estimate the valuation of an enterprise, its equity, debt instruments, preference shares, intangible assets, and then lastly, derivative instruments. So there's a lot for us to unpack, and that's why there's going to be multiple videos for you to work through. We're going to try and group these videos in bite-sized portions for you relating to specific context and specific principles. First video, we're going to look and we're going to recommend what valuation modules should be used given a scenario. This is going to be building on our FBS 300 work. Video 2, I'm going to be taking you through our multiple based approaches, both for the enterprise and for valuing equity. We're going to look at the free cash flow model, building on what we did at FBS 300 last year in our third video. Then we're going to go and look at some other aspects. We're going to look at determining the residual or net realizable value. And Greg is going to take you through that in video 5. Oh, apologies. We're also going to look at the minimum and maximum. That's going to be done in video 4, not video 5. Apologies. And then we're going to compute a fair value for multiple instruments. Preference shares, debentures, convertible instruments, forwards, options, futures, swaps, you name it, we're going to go through it. So this is a one-stop shop in terms of the overall module. Anything that you might see on a financial statement when you're looking at a listed entity, we're going to try and unpack how to approach the valuation of that particular core concept. So at a high level, the outcomes of where we want to be at the end of this process is we want to be able to show and how to determine the value of equity shares, preference shares, debentures, convertible instruments, and then certain derivative instruments. When we're looking at preference shares and debentures, importantly, that is going to be based on our WACC and FBS 300 knowledge. So we're not going to go into any additional detail. Yes, at a high level, I'm going to go through them very briefly in the slides that follow, but importantly, we unpack these principles when we looked at our weighted average cost of capital. And if not, it forms part of our FBS 300 knowledge, which we assume you guys have all retained coming into CTA. Importantly, when we looked at our weighted average cost of capital, what are the things that we needed to take into account, particularly when we looked at debentures, was we needed to bring into account section 24J. When we brought in section 24J, we looked at the deductibility of our share issue costs, we looked at a premium, or we looked at offering at a discount up front, and then looked at fixed and variable rates. Now, these same principles that we use to determine a rate were also used to determine a value. So you'll recall when we looked at these weighted average cost of capital examples, either we gave you the market rate, and then you would use that and back solve to determine the fair value or the market value of that instrument for the purposes of your debt equity split. Now, when we did that debt equity split and we determined that market value, that is the same as performing a valuation on those particular instruments. So the principles remain the same, nothing new. And the reason why I want to emphasize this and stress this up front, and the reason why I think it's not necessary to go into that level of detail, is we need to move away from a siloed approach. We cannot think, okay, now this is a WACC question, so I can only think in terms of WACC. This is a valuation question, so I need to think in terms of valuation. Unfortunately, where we are on our academic journey is we need to realize that there's one overarching principle and everything starts blending towards each other. You're going to find different sections interacting with one another. For instance, WACC, valuations, mergers and acquisitions, all can form part into one unique question. So we're going to look at that very briefly next, but for the most part, we're going to assume that it's knowledge that you have retained from third year. Greg is then going to take you into convertible instruments and certain derivative instruments. Eesh, that's so exciting. Hey, these nuances, some of these things, the things that make a CA a CA, the value that we add in the complexity comes across here. All right, so we felt that the best man for it was Mr. Plants. He's done it before, he can do it again, and there's a reason why we have done so well in the past, particularly relating to these complex situations. And then lastly, mergers and acquisitions, that's going to be done by Mrs. Stain. She's going to take you through that in another module after your June tests and exams. Let's do a quick recap of some of the core principles. So firstly, preference shares. Now, the underlying basis of a preference share is that it is the entitlement to dividends for the virtue of, or for holding that particular instrument. However, in order to determine the value, we need to understand the characteristics that underpin that particular preference share, namely whether that share is cumulative or non-cumulative, redeemable or non-redeemable, participating or convertible. Now, we recall what all these things mean from FBS 300, and these factors all play a part in determining the value of a particular instrument. And it plays a role in determining how we go about that particular valuation of that particular concept. If we look at non-redeemable preference shares, we know that they're never going to be bought back. So as a result, we need to determine the perpetuity value for that particular instrument. In other words, all future dividends from now until the end of time need to be discounted back to get to the value in today's term. So what do? We need to take, and the value of that instrument is determined by the future dividends divided by the required rate of return for that particular instrument. So in other words, what's the market rate? If we've got the market rate, we know what dividend that instrument pays, we can determine the value in today's term. The complexity comes in when there's a dividend in arrears. And the valuation, how we go about that, will all depend on whether it's cumulative or non-cumulative. Because if it's non-cumulative, then we simply just defer our valuation up until such point in time as dividends are resumed. If it is cumulative, all those dividends that were missed have to be paid some point in the future. So for instance, in the next 3 years, if dividends are not paid and it's going to resume in year 4, if it is cumulative, in year 4, you pay 4 years worth of dividends as one lump sum payment. If it is cumulative, or non-cumulative, sorry, then you would only pay that particular dividend that arises in year 4. So that impacts on that particular value. If it's a redeemable preference share, we know that at some point in time it's either going to be bought back or it's going to be converted. At that point in time, the lifespan of that particular preference share will cease to exist. So we determine the value simply by discounting the future dividends along with the present value of the present value of whatever that redemption amount is going to be at perpetuity. All right, so how are we determining the valuation for both preference shares as well as for debentures? It's simply going to be the present value of our future cash flows. Whatever those cash flows are, if we can determine what the value of the future payments are in today's terms, that is the underlying value for preference shares and debentures. If we're looking at debentures, a couple of key terminologies that, again, similarly to preference shares, impact on the value: par value, coupon, the yield to maturity, zero coupon bond, maturity dates. All of these aspects need to be taken into account. And the valuation will once again depend on the instruments. Is it going to be a non-redeemable, in other words, a bond that's held into perpetuity, or is it a redeemable instrument, present value of our future cash flows? If it is a non-redeemable debentures, very similar to that preference share, we take our interest payments and we divide it by the required rates of return. Interest payments before or after tax, it is going to be our after tax interest payment. Why? Because we're going to get an interest tax shield, unlike our preference share. Redeemable debentures, discounting my future cash flows. But what do we remember when we determined the value for these redeemable debentures when we did WACC? Don't forget the impact of Section 24J. This will have an impact on the value of the particular instruments. So what do we need to look out for? Is there a redemption, yes or no? Or is there a discount or a premium on inception, or either there afterwards on redemption? And secondly, share issue costs. Is there going to be a Section 11A deduction for the share issue costs? And then importantly, is there a difference between the market rate and the coupon rate that we are paying for that underlying debenture? If we're in a situation where my coupon rate is higher than the market rate, it means we're paying more. So therefore, most likely, the value of our instrument will be higher than the par value. If our coupon rate is lower than that of the market, it would have to be issued at a discount for someone in the market to be willing to buy that particular instrument. So we'd expect that value to be lower. That's just a nice sense check to remind yourselves of as you're going through that particular valuation. Importantly, as these lines between valuations and WACC get blurred, particularly as we're looking at redeemable debentures, we need to look in the question as to what information is provided. Now, a key concept where students often struggle is you struggle to identify, well, do I need to determine a rate? Has a rate been given? Do I take the market rate? Is the market rate as given the one I can use? And that all depends on the information provided in the scenario. If the instrument is already in existence and you've got a certain rate for that particular instrument, and the market rate that is given in the scenario differs, then you can simply use the market rate. But you then need to go and determine the market or the trading value of that particular instrument by going through the exercise. That would represent the valuation that we're talking about here. And that value would then be used in your weighted average cost of capital structure. If, for instance, you are given and you're issuing an instrument, and the instrument that you're issuing, there's no market rate that's given, you can then simply take the proceeds that you're getting, and that proceeds would represent the market value in today's terms. All right, if you're unsure of some of those principles, go have a look at WAC, go have a look at some of those examples there, or please pop myself or Nicholas a message. Let's now look at unpacking the specific detail of what we're trying to cover in this lecture, and that is the concept of what is value. So, in particularly for equity shares, we want to look at the what's and the why. Firstly, why do we perform valuations? Now, performing valuations can be done for a multiple reasons. Whether we want to acquire or sell a minority interest, determine the value for a merger or a takeover, for tax purposes, for financial reporting purposes, whether or not there's an impairment of an existing subsidiary, for an IPO, initial public offering, to determine whether the value of a security being offered is reasonable or not. There's multiple reasons for us performing the valuation. But the reason why it's so important for us to establish this up front is that as we move on, as we add value and as we add insight to the valuations that we perform, knowing why we're performing the valuation impacts on not only the approach that we take, but certain adjustments that we make. For instance, if we're looking at determining the value of a merger or acquisition, we now need to take into the effects of the potential synergies as a result of this merger or acquisition. If we're looking at acquiring the minority interest or acquiring the interest which would result in us getting a controlling stake in the entity, I've now got to build in or make adjustments for a control premium in my valuation. So the reason behind the underlying valuation or why we're performing it drives the value that we are trying to determine in our scenario. And what we'll also find is that as we're going through this process, you'll start to develop a lot of insight that you'll not only use in your CTA, but when you're out in practice. For instance, you'll all recall last year when my father-in-law passed away. Now, he ran a business, but in order for us to perform and to determine the estate duty that's payable, we now need to determine the value of that particular business. The complexity that now has arisen is the person that was set to do the valuation and provide us with the proof of the valuation overestimated the value of that particular enterprise or that particular business. And if you didn't have someone in the know-how that could challenge the inputs that they used, it would result in a higher value, a higher tax, and importantly, a higher payday for the person that was preparing the valuation in the first place. So having this overall view of why we perform the valuation and the reason for it helps drive potential incentives behind the scenes that impact on the value. We also now need to look at, importantly, what different types of value we have, because it's important to know what the question's actually asking for when you're asked. For instance, if we're looking at historic cost and the value of historic cost, we're simply referring to the original amount paid. Amortized cost is the historic cost of what we paid, less any amounts that have been written off, either through depreciation or either through impairment expenses. When a question refers to the intrinsic value, we are only referring to the present value of expected future cash flows. So if the question asks for the intrinsic value, only the net present value of future cash flows that are discounted at a reasonable rate, either cost of equity or WACC, depending on whether we're looking at the enterprise or we're only looking at the value of equity. But we'll touch on that later. Now, when we look at market value, the distinction between market value and fair value is often where students fall short. When we're looking at this explanation of market value, we're referring to the value which a willing buyer is prepared to pay and which a willing seller is prepared to sell at, as determined by market forces. So in other words, when we are looking at market value, we take into account the nuances relating specifically to that willing buyer and that willing seller principle. And I think the best way to think about it is to actually look at a practical real life example. And this is one example where I was behind the scenes and I kind of knew a little bit about what was going on. And what I want to look at is I want to look at this concept or this principle and this shrewd businessman called Solomon New. Now, yes, you're all thinking, bloody hell, Jason, it's Woolworths again, get over it. I understand that this is a great principle to illustrate. So what we had over here, we had Woolworths who were entering into an acquisition with David Jones purchasing the entity. However, because of competition commission, the company Woolworths had 88% in Country Road. Now, what they needed to do in order for the Competition Commission to approve the acquisition in David Jones, they needed to acquire the additional 12% that was sitting in Country Road, which was owned by Solomon Lew. As a result, when we look at this concept of market value, in other words, how much a willing buyer how much Woolworths was willing to buy and how much Solomon Lew was willing to sell, it was overly inflated for this 12%. Because if this 12% in this deal did not go through, the entire acquisition of David Jones would fall flat. As a result, because of this embedded value that this Country Road, or this 12% in Country Road had, it increased the price significantly, over and above which would have been expected from a normal fair value. So when we look at this example, for this 11 or 12% stake, Solomon essentially sold Country Road, the 12%, for 207 million in terms of the acquisition, right to the 11.8%. To put that into perspective, that was almost as much for that 12% as the entire 88% that Woolworths already owned, as a result of this premium that was willing to charge. And that best illustrates this concept of market value. And we can see this coming through in the article. So Lew has wanted Woolworths to buy him out for a hefty price for the last 20 years. Over that time has been telling Lew to get lost. A few months ago, they made $1 billion or 2.2 billion takeover for David Jones. Lew immediately saw the leverage opportunity, waded in and picked up 10% of the David Jones stock, representing a clear signal to Woolworths that he could block the bid. On Tuesday, Woolworths capitulated and make the takeover build for both Country Road and the percentage in David Jones that he already knew. And as a result of this particular decision that he had, he gained leverage. And ultimately, he took and laughed all the way to the bank. And we'll touch on fair value in a little bit. But before we get there, some other different types of value is this realizable value. When we speak about realizable value, we refer to the net proceeds of any asset or group if it's sold separately in an orderly sale. And the liquidation value is if we have to sell those particular assets today, how much would they be worth? And obviously there are additional costs involved. There would be a discount as a result of having to sell those items in a short space of time. So shifting our focus now to this principle of fair value. We know, and you'll know from IFRS 13, that IFRS 13 describes fair value as the price that would be received to sell an asset or paid to transfer liability in an orderly transaction between the market participants at the measurement date. Now, in terms of this definition, there's a couple of key concepts which we need to define and we need to establish. So the value is based on an exit price, in other words, selling that particular assets or transferring that particular liability. And it's the amount that the market is willing to pay. Now, when we speak about the market for fair value purposes, we're speaking about any buyer. As a result, we ignore any premium and any specifics relating to a potential buyer, which may be embedded in my market price. So when I'm looking back at my market price, I'm taking a willing buyer and a willing seller, a specific person in mind that drives the value. When I'm looking at the principle of fair value, I'm looking at any buyer. As a result, those premiums may be less or they may be non-existent. Fair value refers to this main market, in other words, the greatest volume where traded and the most beneficial market. So the transaction needs to take place on an orderly basis, and it uses various valuation techniques and uses maximum observable inputs to perform the valuation. So you recall there's that hierarchy, level 1, level 2, and level 3, so it maximizes those particular observable inputs in its computation. All right, in order to maximize essentially for its purposes, which is financial reporting. So when we're looking at fair value, an important characteristics and a distinguishness to make in contrast to a market value is that it doesn't take any specific buyers or any specifics related to a transaction into account. And it's done in an orderly basis and in a market where it's highly traded if available. So what does this mean? How do we determine the value of equity in issue? The number of shares in issue is equal to the number of shares less the treasury shares. Market capitalization is equal to the market price per share multiplied by the number of shares in issue. So that's how much we see on the exchange. Free float capitalization is equal to the market price multiplied by the number of shares available for public to take up. Importantly, that this excludes the market cap any premiums for control. So it represents the fair value of equity in issue. That fair value doesn't take into account any premium, any adjustments for control, any adjustments as a result of a specific buyer into account. And I think that's the biggest thing that we want to get across here. Difference between fair value and market value. All right, so you must always be aware of the value on which the calculation has been based. Has it been based on the closing price? Has it been based on the opening price? Has the spread been taken into account, etc., etc.? Why? Because this drives what is going to be expanded on in terms of our maximum and minimum price. There's always what's referred to as a bid-ask spread in the market, how much people are willing to sell for, how much people are willing to buy for. And we need to know what we're looking at when we're determining the fair value of this particular instrument. We now turn our attention to the how. How do we go about determining this valuation? In other words, we look at the approach, the methodology, methods, and various models that we have at our disposal. If we take a step back and we think about IFRS 13 once again, and we think about financial reporting. Now, when we're determining the value, the premise of value is that it must always represent the highest and best use. In other words, we must juxtapose and choose the higher of either value in use or fair value less cost to sell. And that's what we're trying to determine. What has got the highest value here? In other words, if we continue using this asset, how much cash flows, what we're going to get from it, or if we have to sell it now as part of an orderly sale, how much would we get? Now, the value is the higher of these two. And it's not always necessarily the value in continued use. So that's the first thing. What is the premise of value? Second aspect is what is the valuation approaches we have at our disposal? And we've already touched on two of these in FBS 300. The first thing and the first approach is the replacement value approach. In other words, we look at valuing the individual assets. If we have to sell them off today, how much would we be able to sell them for? And it's the accumulation of all the sale of those particular assets. The downside with a replacement value approach, when you are doing the valuation of a going concern, is that it takes out any synergies within the business. In other words, how assets interact with one another is ignored. It only takes the sale value of those particular assets. The next approach is the market comparable approach. So this is your multiple based approach using your price earnings or your earnings multiples. All right, we remember from FBS 300 last year, what we did was we looked at our sustainable earnings. We got that reasonable rate from the markets, looking at either price earnings multiple, or our earnings yield, and we determined the value based on that similar listed entity, and we made adjustment for differences. The problem that we have with this market comparable approach is twofold. Number one is that how do we know the underlying value of the particular business which we are using as a comparable company is reliable, number one. And number two, we are making certain adjustments to that. How accurate are those adjustments, or how can those adjustments be verified? What we're going to move on to in FBS 705 is looking at, in addition to these two approaches, is we're going to look at the income approach. And when we're looking at the income approach, we are determining what is the value of the future cash flows which that entity or that business generates. In other words, we're looking at, we're looking at this, the value in the continued use of those particular assets. So what are the value drivers when we're looking at the income-based approach, when we're looking at a free cash flow? Number one, the value drivers, cash flows and returns. How much cash flow are we getting? We look at the timing, when we are getting those cash flows, how reliable are those cash flows, what are we discounting by, and we're looking at the risk, and we need to adjust either the cash flows or the rate when we look at that particular, or take into account those particular risk factors. All right, importantly, I think an important concept just to bring about here is how we're making an adjustment for this risk. Either we can take a discount and leave the discount rates as it currently stands, but be more prudent in our cash flows. In other words, take them into account, take the risk into account in the future cash flows that we forecast, and discount that. Or we increase our discount rates, increase our discount rate for the increased risk, for the increased credit risk, etc., etc. So the various models that we're going to use, if there's going concern problems, then we look at the liquidation value. Otherwise, we look to try and follow an income-based approach, either using a free cash flow model, EBIT or EBITDA multiples. We can either look to earnings yield or my dividends yield. All right, and that will all depend on the information. Importantly, something just to note at this particular juncture is we value all our dissimilar assets separately from the rest of the organization. All right, so obviously we want to try and look at our free cash flow or our EBIT, EBITDA multiples, because these are more reliable. The other aspects, which isn't jotted down in the slide, but I think important to note now, we will talk to it later on in the videos, but it's important to be able to identify what are we valuing. Are we valuing the enterprise, or are we valuing equity? Because they've got two different aspects. Enterprise takes into account all debt, so we've got to get a fair market value of our debt and on my preference shares. And when I'm looking at equity, I'm only taking into account the value of my fair equity. So we'll touch on that later on as we go through, but something just to keep in the back of your mind as we move forward. So how do we go about choosing and determining the choice of a valuation model? The first question we've got to ask ourselves is there a going concern? If the company is not a going concern, we've got to use our liquidation method. In other words, we've got to determine how much can we sell these assets for. That's what we've got to determine. If it is a going concern, the next question is it a controlling share? If not, we look to our dividend yield methods or our dividend discount model. If it is, we're going to ask ourselves, are all the assets within this business under the same risk category? If they're not, we're going to look at use the net asset value method. In other words, value each business unit separately and add them up separately to determine the overall value. And if they are, we've got to then ask ourselves, are there future cash flows? And is WACC available? If not, we look to our earnings multiples. But if they are available, we look towards a free cash flow model. All right, and this is just useful for you to have that overall picture of where we're going and what we are actually doing. The last aspect to look at in this particular video, and the last questions to consider, is something you should always think about as you're doing your valuation. And first thing that we need to ask ourselves is, do additional benefits arise? Because if additional benefits do arise, then we might need to determine a range of values. depending on what those benefits are and whether those benefits are accurate or not. Next question, are we valuing a going concern? Because if we're not, the value may lie in a value in use calculation. In other words, if we had to use these assets into perpetuity, how much cash flows would these assets generate? If we are a going concern, the value may lie there, and it would impact on the valuation method that we use. Does the enterprise have a temporary lifespan? It can only last for a short amount of time. Then we cannot capitalize our returns. So a nice example of this was in 2010, one of my friends opened up a little business, and on one of the fan walks in Cape Town, he then sold vuvuzelas and hats. And this paid for him to be able to take a trip overseas afterwards to go visit a country that he always wanted to go visit. But this enterprise only had a lifespan. So if we were to determine the value of that enterprise up front, we would not be able to include a value into perpetuity, because once the World Cup ended, the sale of those particular vuvuzelas and of those particular supporting hats would no longer be valid or viable. Is information available to the forecast? Is there information available to forecast free cash flows? If there are, great. Do a DCF, discounted cash flows, because this is the best and most accurate way to determine a value. If not, we might have to look at one of the other approaches, which would be a multiple based or something else to that effect. Does the valuation relate to the business, in other words, the operations, or the entity? And it would determine, and the rationale for this would be to determine whether or not dissimilar assets need to be valued separately, or if it is for the entity as a whole, for the business organization, the business as a whole, we would value it all together. If it's for the entity and you've got certain assets that do things independently, we value those particular dissimilar assets in a way that's best suited for them. And then lastly, is a control state being valued? Because if it is valued, we cannot use a dividend-based approach or a dividend yield. Why? Because we're valuing a controlling interest, not just the residual share. And that was a concept that we unpacked a little bit more last year in FPS 300. These questions will just help you derive and determine how to go about your valuation and the best possible way to go about it to add the most value. That brings us to the end of lecture video 1. I hope it set the scene. I hope it made you excited for what is going to come in this valuation module. Remember that price is what you pay, but value is what you get. Thanks for now.